Hello, this is Mitch Goldberg. We are just getting started. If you're joining us, thank you so much for your patience. This is a brand new live episode of Be the Boss of Your Money. We're going to talk about some very fundamental things that I think are taking place in the market now that I think all investors need to know about. It doesn't mean you have to react to every little thing that we that we talk about, but I do believe an educated personal finance person is better off. And that's what this is about. It's an educational show. It's about personal finance, investing, business talk, and lots of things that fall underneath that umbrella. So we've got a lot to talk about, but there are some fundamental shifts taking place in the market. They take place basically every cycle. So this is nothing that is overly new, but I think it's important that you know about it. And if you don't know about it, you're going to learn something new, and it'll make you better with your money. If you already know it, I think maybe there's a few things about it that maybe you're not aware of. And this is very timely because there's a shift taking place in the stock market. And what you're seeing now is you're seeing the early signs of investors factoring in a stronger economy in 2021, not just like a recovery, for the third quarter and then, a drop in the fourth quarter, but an actual economic recovery taking place. And it's happening, and you could see it. Now, you might not believe that a recovery in the economy is taking place. We're still in a recession. Things are still pretty lousy out there. That's not the point. Stocks move ahead of those things. By the time you see an improved scenario in the stock market and in the economy, by the time you see things improving the economy, the stock market will have already reflected that. So we're going to talk about cyclical versus growth and what's taking place in the market right now, what you need to know as an investor. But the bottom line is you don't have to react to every little thing, but you should know about it. Make sure you're prepared. This is just part of personal finance. And the fact of the matter is you need a little bit of everything. I'll explain exactly what I mean by that. So the first thing we're going to do is roll a quick intro. We'll do the quick update, and we'll be nice and happy and snappy today. Here we go. Thank you so much for joining me. I'm Mitch Goldberg. You're watching Be the Boss of Your Money. This is about personal finance, education, about money, all things that fall under that umbrella. Personal finance could cover everything, but I want to get granular, specifics. We talk about investing, different kinds of investments. We talk about financial, everything financial, from estate planning to taxes, you name it. We're going to talk about this. I have two guests next week to have on. One is going to break down the difference between the Biden tax proposals and what we know of the Trump tax proposals to see if, who the winners and losers are going to be and if we're really going to be better off with one or the other. If you're watching this in the live, I want to welcome you. Feel free to ask any questions you may have about the subject matter, personal finance, business, investing tips. Ask in the comments. Your words of encouragement, your words of wisdom are always appreciated in the comments as well. And if you're watching this in the replay, I'd like to welcome you as well. Thank you so much for taking your time out of your busy day. I hope I provide you value here. If you have any questions, certainly for you as well in the replay, ask away in the comments. I'll definitely see them. I'll get an alert, and I'll definitely get back to you. We've got a few people out there already, so I just want to welcome. Hey there, Mike. Happy and snappy, the new tagline. I didn't even think of it like that. It's just happy and snappy. Yes. Maybe maybe you and I will make a t-shirt. Maybe you'll be a guest, Mike, and you'll wear like the happy hat, the hat that says happy, and I'll wear the one that says snappy, and we'll put it together and we'll be like happy and snappy. Look at that. I'm a marketing genius. I know. Anyway, thanks, Mike, for noticing. Mike Stewart coming in from LinkedIn. Thank you very much. Paul is out there, all buckled up, sir. Let's go, man. I love the enthusiasm. Thank you very much. All right. So we're talking growth. We're talking cyclical, but you have to take a look at what's working. So I'm going to just share my screen. We're going to do a little bit of a different review. So this is going to be it, guys. This is it. This is it. This is going to be good. Oh, yeah. Okay, here we go. Yeah, okay. So Dow is up 152 points, pretty much closed at its best level of the day. Same with the S&P up day, NASDAQ up day. Really big update. Good update for the Russell 2000, up 1.6%. That is an indication of investors getting comfortable with the economy. Yesterday, we spoke about interest rates. And what I said is we have a pretty steep yield curve now. Like we're past that whole inverted yield curve danger, which, by the way, was right. The yield curve, when it was inverted, did again predict a bear market. It didn't predict a pandemic, but nonetheless, it was a useful measure. So I think it's like 9 for 9 now, since like 1960. Anyway, the yield curve is improving, and that just means longer term rates are a lot higher than short term rates. And that means, essentially what that means is banks could actually make money lending money. They could actually make money on loans. And the more loans, the more credit that the banking sector creates, the better money multiplier. It's just better for the economy. So let's just take a quick look at a couple of things. I want you to notice something, the industrials, okay? GE solidly in the 7s, so kind of sneaking up out of the 6s. Did any of you notice that? By the way, Victor is out there. Michael is out there as well. Good to see you guys. Thank you for joining me. GE Southwest Airlines, look at that, up 5%. That's an important one. UAL up almost 5%. Look at this. CSX Railroad, Corn Ferry, employment firm. Boeing, nice day up. American, Wabash. You know Wabash? They make trailers that go, for the tractor trailers. They make the trailers that go behind the tractors, okay? And they have a little map of the United States. It's like a shape of the U.S., a red USA with the word Wabash through the middle. And now that I just told you about that, you're going to see that all over the highway. Like every truck you see now is going to have a Wabash plate at the end of the trailer. So take a look at that. Honeywell, Johnson Controls. Okay, you see what I'm seeing? You hear what I'm saying? 3M. What you're seeing here is just a really big move in the industrial stocks. I get so excited about this. There's a shift going on, and some people will call the industrial stocks the value stocks. I think there's a difference between value and cyclical. Value stocks are trading on their own. Just when things improve, maybe they'll go up. Cyclical stocks could be down like a value stock, but they'll go, when they'll go up, when the economy goes up. Okay. And that's what's happening. But take a look at this home run of a sector here. Financials, Travelers, JP Morgan up over $3.50. Bank of America, AIG, Morgan Stanley, okay, KeyBank, Citi, Wells Fargo. Wow, even Wells Fargo is up for a change, right? Just kidding. Listen, they'll get through their banking, account scandal thing. I just don't know if anybody was, victimized by the scandal would ever go back to Wells Fargo. But that's a story for a different day. That bank will come back as well. American Express, Goldman Sachs, Berkshire. Look at, okay, so Visa is off, PayPal. But Visa and PayPal, they're really not financials. They're more like they're called fintech, financial technology. They're just transaction companies. They don't really make money on interest rates and spreads, things like that. Even US Bancorp is up. IAT, that's the ETF for the regional banks. And then you take a look at this, okay? You look at consumer discretionary. So here are your typical consumer discretionary. Smile Direct. Smile Direct was $3 and change not too long ago. Okay. You look at Macy's was up today. Marriott Hotels, something we look at every day, is one of the reopening stocks, and Kohl's is another reopening stock. Ford's been getting out of the $6-7 range. GM it's not too far from 40. Uber finally moving. Uber's around in the mid 30s for a long time, but Ralph Lauren, Dunkin', I think Dunkin' that's a new high for Dunkin'. Sirius Satellite moving, Discovery. Capri Holdings. That is Michael Kors and Coach. No, Coach is Tapestry. I think Capri holds Michael Kors. I have to. Yeah, I'm pretty sure I'm right on that. TJX, Under Armour, Five Below, Starbucks, Harley Davidson. These are consumer discretionaries. I should have put up energy, but let's take a look at what the winners of the day today were. Consumer discretionary. Okay, so that is just great. Happy and snappy. That's right. Happy and snappy. Roberta is out there. Hey, Roberta, good to see you. High school friend. All right. And we've got Sean is out there. Politics seem to be head faking the market back and forth with stimulus discussions. Are you positioning for no stimulus? Okay, Sean, we're going to talk about that because that's like, it's like the elephant in the room, right? So let's definitely address that one. Victor, I see you out there. I'm just going to hit up with Sean first. I love this, man. So let's talk stimulus first. So we're going back and forth. Like the market was down, and then it was up when Nancy Pelosi came out and said, "Oh, we're getting closer on things." And then later in the day, she says, "Yeah, we're not that close." I think the politicians should all just not say anything publicly. If they have a deal, announce it. If they don't have a deal, then they can announce that too. However, if we don't get a deal now, the reason why I don't think the market has a big sell-off is because investors are expecting stimulus. If we don't get a deal now, that we'll get a deal in February or March, plus probably a $2 trillion infrastructure bill as well. Think about what that does for materials companies like steel and copper and all that. Okay. And think about how many people will be put to work, how many machines you'll need from Caterpillar and trucks and all that stuff. So if we don't get a stimulus package between, let's say, now and the end of the year, I actually said this the other day. I've been on record for this. Just want to throw it out there again. I think we could see maybe a 5 or 10% correction. Maybe. I don't even think that much, but I think 10% is like the most, because if you don't get the stimulus now, you don't want to sell your stocks because you'll be getting it later on. Regardless of who wins the election, I think we've got more stimulus coming our way. If the Democrats get a blue sweep, we'll probably get a ton more stimulus. If we don't, then we still will get some kind of stimulus because politicians still want to keep their jobs. We've got another election coming up in 2 years for more senators and reps. And then, and we're already talking about 4 years down the road, 2024, right? Is Biden going to run again if he does win? Yeah, I know we're talking about these things already, but let's focus now. So just to answer that, Steve, the back and forth stimulus discussions, I am positioned for my clients the way I think they should be positioned for their personal finance. If you're a long-term investor and you've got 20, 30 years or more out to retirement, you've got 10 years plus for your child to go to college, I'm not changing a thing. And if you're already near retirement or you're in retirement, for example, for someone like that, I'm not changing a thing because we've already made the necessary changes. A bear market, a correction can happen at any time. A bear market can last a long time. So you have to be ahead of the curve. So I'm not actually making any changes based on the election or based on whether or not I'm more bullish or more or less optimistic about the stock market. It's based on everybody's personal finance. Victor is out there. Any recommendations or mistakes to avoid for a new student looking to enter the stock market? Have a good day. Have a good day, man. Thank you so much for asking. Okay. The mistake right now when you're young, college student, you've got a couple of bucks to play with, and I'm going to assume you're playing with a Robinhood account. I know it's like an assumption because you're a Gen Zer, and I just automatically assume you're using Robinhood. But you'll probably come back to me and say, yeah, you're right. I was using Robinhood. Well, if you're using Robinhood or any of the other online accounts because they have partial shares, you could buy fractional shares today, which is an amazing thing. I can't even do that. I'm an investment professional. I can't do that. I wish I could do that, but I would say your biggest mistake is worrying about making mistakes when you're young. You need to try. You have try to make money in the market. Don't let anybody tell you about, oh, you can't market time. You have to learn all these lessons for yourself. And you have to not just read about what somebody says about investing lessons or hear what somebody says. You have to do it yourself, and you've got to have the experience. There was an article on CNBC. My friend Michael Wright sent it to me. I had already seen it, but I think he was pretty miffed by it. We have to talk more about this, but it says something like the stock market is being led by young and dumb people. Now, listen, young people have always gotten into the stock market and have experimented and tried to learn about it and trade, invest, and all that. And that's great. I think with the advent of Robinhood, it's just that it's been able to be scaled up a lot more. So you have a lot more people playing in the market because you could also, open up an account for like $100 and learn that way. All right. So I don't think it's dumb. I don't think it's stupid. I think it's good. It's just that we're doing it more at the same time. So my thing is, go ahead, learn, make mistakes, and enjoy it. Enjoy the journey, because the money you play with now there's not too many times in your life when you could try something and be wrong, piss away money, and you'll be okay. You're not gonna probably want to do that when you're my age. All right. And my oldest child is 21. So that's just what I'd say to anybody. Okay. So there you go. Thank you, Victor. Carlos is out there. Hey, brother, look at Dr. Copper and stocks like FCX. I know, material stocks. And have you seen like Dow Chemical? Chemical stocks are flying. And thank you, Carlos. Carlos is my friend and fellow financial advisor. So if you have any more questions, keep them coming, folks. I'm going to see them. I wish I could just answer questions the whole live stream. So the point I'm making, though, is you're starting to see cyclical stocks do very well. I want to see if I could pull up some of my material stocks. Okay, so let's just take a quick share screen, take a quick gander at this. I want to show you some of the material stocks that I follow. You see this? Hammett, forget Hammett, but you see Vulcan Materials, Martin Marietta Materials, Alcoa Aluminum. Okay, you see U.S. Steel. That's the one that Carlos just mentioned. FCX, right? Look at FCX. All right, here it is, up 3.5%. Nucor Steel, but gold has been doing poorly, and gold miners have been doing poorly. But other than that, the material stocks that I follow have been en fuego. I mean, it's just been incredible. You're really seeing a very big cyclical bounce. And cyclical stocks, just so you know, are the ones that are very sensitive to the economy. So if the economy gets stronger, companies like Caterpillar, John Deere, Southwest Airlines, Dow Chemical, they just do better. When the economy does better, you see an interest rates start to rise. That's also good for the banks. When interest rates are rising, that's typically an indication that the economy is starting to get a little bit better. Maybe there's a little bit of inflation coming up, just a little bit. Some people are worried about interest rates going up. There's two kinds of interest rate rises, though. If interest rates spike up really, really fast, like they did like about 2 years ago, that would hit the market really hard because it creates a bunch of dislocations. And then big investors, professional investors, they just sell everything. They don't care if it's a industrial or a bank stock that could do well, or if it's, a tech stock. They just blow out of everything, and then they come back and pick and choose. But if interest rates kind of go up in a gradual glide path, we could really adjust pretty quickly. Your growth stocks, the companies that are not sensitive to the economy, like drug stocks and the big tech stocks, the FANG stocks like the Facebooks, Amazons, Apples, Google, Netflix, and Microsoft, FANG M. I talk about these stocks like every day, and I love them, but I'm so sick of talking about them. But those stocks look particularly well when economic growth is slow. So when interest rates are really low, it makes any kind of growth look really good. But all of a sudden, interest rates go up a little bit, the economy improves, and cyclical stocks take off. And that's what you're seeing. You're seeing, I'm not going to call it sector rotation because I don't really see a wholesale dumping of tech stocks and high flyers yet. But high flyers, the stocks that have gone up the most since the bottom of the pandemic lows on March 23rd, there's a lot of stocks that are up 100, 200, 300, 400%, and that have not just recovered from their pre-pandemic highs, but have exceeded those. I think that's probably the source of where money comes from to fund purchases of the kind of stocks that we're seeing rally now. When you see interest rates go up a little bit and the economy is expected to get stronger. And again, that's industrials, financials, materials, consumer discretionary, and energy. Those are the places. We just saw ConocoPhillips buy Concho Resources, another oil company. So I think we're going to start seeing a lot of consolidation in the energy patch. And that's also, I think, a pretty bullish indicator for not just the energy stocks, but for the market as well. So that's a very pretty bullish case that I'm laying out here. And I think we will get the stimulus. Plus, we still have the Fed. The Fed said they're going to stay at or near zero into 2023. So let's not get too negative. I'm not making any changes on stimulus. I'm not making any changes based on the election either. Whoever wins, the market could have a dip, go up or down. But I'm looking really, past the election. And I think all investors should. If you have money that you need for a financial obligation in the next year or two, I don't think that money should be invested in the stock market. I think preservation is your goal for that money. But other than that, if you have a long-term time horizon, the stock market has done generally well under almost every president since 1900. World War II and George W. Bush had lousy stock markets, bad, negative performance during their presidencies. But Bush W, okay, his presidential term, his second term, also coincided with the Great Recession. So that has obviously a lot to do with it. All right. Thanks all for watching. Giddy up. Thank you very much. And I don't do these streams on Fridays. So, but I do put out a really good email blast. If you want, let me know. I'll put you on the list, and I'll be back Monday with a brand new live stream and have guests Tuesday and Wednesday next week also. Thank you so much.